our obligations under the scheme. So the banks have to follow the process and have to carry out fraud checking that they said they were going to do and show evidence that they have done so.
Yeah.
Then, if that loan particularly is not paid back because the customer cannot pay, or turns out to be a fraudulent loan, both cases mean a claim on the guarantee.
My understanding is if it's a fraudulent loan, then then actually it's on you rather than on the taxpayer. You can't. The agreement between you and the government is that you couldn't reclaim in that circumstance.
No, the agreement is that and I think it's important for everybody to understand this, and that's why Starling is so really, really focused on fraud, is that the definition in the scheme is that the banks have carried out their fraud processing. And if the bank has carried out its fraud processing and it is then subsequently found out that the customer was a fraudster, that is still a default and it's still a claim on the scheme. And that is why Starling is so absolutely rigorous in using all its systems to make sure that we do the best we can to protect taxpayers' money. And back in May, I blogged and I basically said that every single pound that goes to a fraudster is one less for the NHS. And that is why we have to be so careful that we don't, in a couple of years' time, regret this move.
So can I just clear with the others, because it certainly hasn't been my understanding that actually if your AML and know your business, know your customer checks don't work, and you do end up issuing a bounce back loan to somebody who turns out to be a fraudster, that you would then still claim it on the government, claim it back from the government. Paul, is that what NatWest would do?
Yes, so my understanding is that there are very detailed requirements laid down in each loan scheme, so be that C bills or B bills, and then the obligations of the banks. So NatWest, in my example, to ensure they've undertaken certain fraud and financial crime checks, and then to prove that those checks were in place, and then that creates the platform for a valid claim on the guarantee.
But even if your checks didn't identify fraud, because clearly if you did have concerns under AML, then you wouldn't actually issue the loan. So that presumably the 1% that you cited before are cases where it subsequently became clear, or you subsequently had suspicion of fraudulent activity, even though you did the checks. In those cases, would you still try and claim?
I think I understand the distinction you're making, Mr. Brown, which is if the fraud checks and controls failed, then that would negate the claim on the guarantee. So my understanding is that would be the case if in effect the fraud checks hadn't taken place. I'd have to check specifically around whether the fraud checks were in place, what position that created. One of my peers may be able to clarify the details.
Amanda.
Just for the interest of transparency, I think so. For example, if we all do our checks and the customer decides not to pay us back because they've taken their loan for the wrong purposes, the banks can then claim on the government for that. Yeah. And in the early stages when we discussed the scheme, we highlighted that there would be a high level or level of fraud. This is the first time we've ever had a self-certified scheme when we look at bounce back loans. There were no checks done around eligibility really. So that to build for that is quite a different scenario. And this was discussed with HMT and British Business Bank and UKF back in I guess at the inception of the scheme. So there could be a scenario, and this is why all banks, to Anne's point earlier, have been very vigilant and had to trade off speed and pace of execution because of the need to make sure we've done what we have to do to protect ultimately the wider society.
No. So David, you had your hand up. I'm on a specific question of if you had suspicions of fraud, you wouldn't have issued the loan. So it's in the cases where the KYC, where know your customer, know your business and AML checks failed and you've issued a loan that turns out to be fraudulent, would you still claim it against the government?
Well, I think Anne's made the point, which is that the scheme was absolutely designed for speed. So the banks will use all of its same checks and balances on a bounce back loan to the same extent it would under any other loan. What is fraud? If there's a fraud which is an existing bankrupt, a dormant account, or a CFAS, I mean, those are very clear. If someone has exaggerated their turnover within the original application, given the implicit and inherent design of the scheme, the banks would never know. If they said my turnover is 250,000 instead of 200,000, the scheme was designed full speed. Therefore, the banks made no checks in terms of that. Now, you'd still say that's fraud. I think we'd all say that's fraud.
So it depends on the type of fraud, effectively.